Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and we continue to put forth all the updates in a highly active week for the financial markets. We have had a lot of central bank meetings in this week, with Fed completing their updates yesterday. US Fed did a 50 basis point hike and made few remarks. One of them being the job market still continuing to be strong, but they also moved the median rates higher for the years 2023, 24, and 25. They also mentioned that the pace of hikes towards these terminal rates can be slowed down a bit. So there has been some bit of a attempt by the Fed on the forward guidance, but not really enough. And the investors continue to seek more inputs. Likewise, we have the BOE and ECB with their rate decisions coming up. So, JK, I'd like to know from you, how was the Fed meeting perceived by the market participants, and what should we be expecting from BOE and ECB?
Good morning, Shikhar. It's a really very heavy day as far as Indian timing is concerned, because it was at 12:30 a.m. we had the Fed, and in the evening at 5:45 we have 5:30 we have the BOE, and 6:45 we have the ECB as well. So what stands out after the Fed meeting is how divergent the market expectations have been related to what the Fed is trying to convey. Notwithstanding how the market reacted immediately after the FOMC decision and statements, I see their statements as more hawkish than what was expected, mainly via the dot plot in the ACPs. The 23 median dot plot moved to 5.125% from 4.6% earlier, and major league hawkish is 17 out of 19 FOMC members plotted 5% or higher. The higher for longer message continues, and Fed has kept a bar for rate to pause much elevated. Chairman kept hopping on the fact that inflation still remained quite high, notwithstanding a welcome drop in October and November. Services inflation will take much longer than goods inflation to drop, although rentals can start to moderate soon. Rates need to stay higher for longer, and refrain from giving any hints as to the quantum of February hike. He highlighted that 17 out of 19 preferred 5% or above for this for the year 2023. 7 out of 9 seeing 5.375 to 5.625%, and a whopping 14 out of 9 that see 2024 from 4.125 to 5.625, while the market looks for a rate cut in 2023. Notable downgrade to GDP in 2023, down from 0.5 down to 0.5 from 1.2%. Core PCE is now seen higher at 3.5%, up from 3.1 in September. So much of the market moves post-meeting and pressure has less to do with the outcome than other factors. Bond players are preferring to remain long into the possible illiquid year-end, while stock players would like to see how the decades high interest rates affect companies' earnings. We will have the fourth quarter earnings coming in January. We may well be in a brutal bear market for bonds and stocks in January, according to some experts, as high interest rates starts to bite and yet to reflect the effect of high funding costs for entities. Interestingly, US futures, in fact, now expect 70% chance of a 75 basis points hike in next meeting. Obviously, this will keep undergoing some changes as and when we get the more data. Currency markets have been a story altogether. Direction of non-dollar currencies is as much dependent on the performance of respective economies relative to the US as the Fed policy. Picture of the former is turning positive recently, supporting the currencies like Euro and GBP. For instance, the IFO said yesterday that German economy will see a mild growth of 0.1% in 2023 compared to earlier forecast of minus 0.3%, and the economy is expected to bounce back with a growth of 1.6% in 2024. Germany, of course, is the largest economy in the Eurozone, and the growth there influences the whole region. At the same time, market is forward-looking and having discounted a poor performance of the economy due to energy issues and war. Now that is being reworked. Hence, we are seeing euro being well supported and in a strong recovery mode, which can extend to 10750 or 10850 before stalling. Similar is the case with GPP, where employment, trade, and industrial production have all bounced back, and yesterday's inflation was reported to have eased slightly too. It's completely different picture, and the confidence in the economy and its macro picture compared to what we saw in September. A staggering rise of 20% in the value of pound, it appears to be reaching overbought level, hence it could stall at 1.25. Series of intervention efforts and US yields, which have fallen 60 bps in 2 years and 85 in 10 year, have helped the low yielders like yen and Swiss franc as well. Coming to your question of what ECB and MPC could do, they will obviously wind up the monetary exercises for the year today with hikes of 0.5% each, which is of course discounted, but we look to central bank's language as to the future course of policy and the economic forecast. As we near the year end, we will not be surprised to see some profit taking in these currencies having risen very strongly. One more point is, while everyone is focused on US inflation and the Fed, Japanese yields are once again quietly pushing at the highs, and there are subtle hints of policy change in Japan, even as Kuroda is in his last legs as BOJ chief. It's important to watch Japanese yen closely in the coming days, or maybe in the first week of January. Coming to our own market, we had a mild rally in INR yesterday, trading below the lows of last 2 days. And what was positive was the move being influenced by inflows and not so much by the central bank. As dollar liquidity shows signs of improving, we have also seen forward premiums inch up from 1.65% of the lows to 1.99%, rekindling some interest from exporters. Even so, we are still underperforming the dollar index and other EM currencies, and a catch-up seems imminent once the flows become more consistent. For now, though, I'm expecting 80 to 10 to 80 to 90 range to hold. On other India-specific news, WPI is to 21-month low of 5.85% in November from 8.39 in October. This is the sixth consecutive month of WPI fall, having seen 16.63 in May this year itself. Of course, WPI has less influence on RBI's monetary policy. At the same time, a slightly negative news, oil settled up more than $2 a barrel after OPEC and International Energy Agency forecast a rebound in demand over the course of next year. And as US interest rate hikes are expected to ease further alongside the slowing inflation. So all in all, very hectic day ahead, because it's not only the central bank meetings, also a raft of data from US, including industrial production, retail sales, and manufacturing surveys. So look forward to it. Of course, before winding up, mostly for the year, although the rest of the 10 days or 10 to 12 days could only be, just range trading or very subdued markets. Thank you.
Okay, JK, that was quite good and refreshing. I mean, even in an active market, there's so much to cover, and you've covered almost everything quite thoroughly. Divergent market expectations on what Fed wants to communicate was initial insights, but at the same time, I do like the kind of commentary which the Fed gave on the service inflation, which will take longer than the goods inflation to moderate. But at the same time, yes, folks, there's a concern on the higher funding / borrowing cost that that can bite in the earnings, which we'll start seeing in the next year onwards. On the ECB and BOE front, even though the rate hikes are quite well discounted, as JK mentioned, the language that the central bank use and the forward guidance that they provide is what is going to be key. One of the very sneaky thing that we have observed, and JK rightly mentioned, Japanese yields have started moving towards the higher ends, and there can be some structural changes on the policy. And for folks, it needs to be seen that we keep a good watch on the Japanese yen. On the domestic front, as JK mentioned, the forward premiums have started recovering the kind of losses which can make it somewhat, even though not right now, favorable for the exporters. And as we've seen some bit of flows coming in yesterday, it needs to be seen whether these flow continue to be imminent for any kind of a recovery as Rupee continues to underperform. That's it for today, folks. We shall come back again tomorrow with another round of updates, which will be from the BOE and ECB. Thank you so much for listening.